Good evening, Prof.
Hello, Prof. Good evening.
How was your day, sir?
Yeah, it was fine. It was fine. Oh.
It
How was
sounds
your day also?
It was okay. It sounds good, sir.
Have you started going to office?
Not yet. Oh, just went to. I think just few days, sha, but working. I'm still working from home for now.
From home.
Yes, sir.
Oh, okay. Likewise, mine. Also. I'm also working from home.
You guys will even still be at home for now.
We are working from home. Everybody are working from home.
Your other colleagues outside the country, they are still working from home.
Yes, all of them are still working from home.
Yeah.
So
Welcome, sir. Sir?
since everybody, I think since our other intercompany sister company are working from home, until they give us instruction and from global, we cannot do anything. We cannot resume.
What did you say, sir?
See, until they give us instruction from the global, we cannot resume.
Okay.
Mm.
It's all right.
All right, let's wait for the student. Thank you.
Let me make you co-host.
Yes. can see that Temitope has come. So we can just start. All right. Good evening, Temitope. We have actually been waiting for you. So I think without wasting much time again, we need to just go straight to what we have to discuss today. I believe the other student will join us as we continue. So I want to believe that you have a great day today. And so my name is Ayodeji, the second lecturer for the FA. All right. The materials that we started last week, last class, is what we are going to continue, even though I've updated it and I've also shared it, with us. So that's what we are going to continue today. And let me just share my screen straight away because we are 15 minutes even behind the time, behind the schedule time. Let me share my screen. So, I believe you can see my screen. Okay, Prof. Adesua, can you see my screen?
Yes, I can see your screen.
Oh, all right, thank you. So we are going to continue with the topic that we started in our last class with me, of course. So maybe I don't need to go through the class through. By now, we should be familiar with the classroom. We should be familiar with the classroom, so I will not need to go through the classroom one after the other anymore. So if you're having any difficulty in connecting, maybe you can reach out to our help desk or help line. And also, if you have any question, you can also drop your question through our chat button. And then also, you have access to us 24/7. If you are reading your notes and you are studying, there is something that you need to clarify that you don't understand, you can as well, drop it in the WhatsApp note, and then we attempt to it. Okay, last week we started in preparation of a partnership account. Preparation of a partnership account, and last week we were able to deal with 1 and 2. So today we are going to finish with 3 and 4. So we were able to discuss the feature of partnership, and we talked about briefly. We talked about the definition of partnership. We talked about those features of partnership, and we talked about the account of partnership. These are some of the things that HiCAN we always test in our OBJ, especially in our OBJ. And those things that they are very, very important. Those 1 mark, they are very important. We talked about partnership capital account. We talked about current account. These are those things that we are going to make use of by the time we are preparing partnership account. We also discussed very well on the sharing of the profit. How do they share profits? And then we also talked about notional salary and notional interest on a long-term capital. What is notional salary and notional interest? I think I've seen in your past question in Pathfinder where HiCAN ask that what do you mean, what do you know about notional salary? So we talked about it. We even give an example of a notional salary and the interest. So if you go back to your note and read your note, you will understand better. Please, I think I need to say this. This time around, we should not pile up our notes. Even though they have not announced the time for the exam, the way we are looking at it now, the exam, the date will just come like a thief in the night. Even though ICANN said they are going to give us 1 month in 1 month's notice to write the exam, but please, especially if you have more than one paper to write, it's always good for you to go through your notes. Don't pile it up. We discuss also on changes in the partnership agreement on profit sharing, and so on and so forth. So those are the things that we discussed last week. So those are the things that we discussed last week, and we are able to prepare, short account. But I believe today we'll do a comprehensive account that will combine most of the things that we have discussed even last week and some of the things that we are going to discuss today. So we consider them, we will treat a comprehensive ICANN, and question today. So let's start from changes in partnership. Changes in partnership. Now, this is where we are going to start today, changes in partnership. Now, under the changes in partnership, we talk about introductions, we talk about goodwill, we talk about accounting for change in partnership. How do we account for change in partnership, accounting for change in partnership? We also talk about admitting a new partner. We talk about admitting a new partner. We also talk about retirement or death of a partner. Retirement or death of a partner. So a partnership may change due to different things. There are a lot of things that can actually bring changes in partnership. The only thing that is permanent in life, one of the things that is permanent in life is change. Change is one of the things that is actually permanent in life. So partnership also can experience this thing called change. So a partnership may change due to different things, apart from even what I actually mentioned here. I mentioned 3 points here that can lead to partnership changes in partnership. I said number one is admission of a new partner to the firm. Admission of a new partner to the firm. It can lead to changes in partnership or change in partnership. A death of a partner can lead to a change in partnership. Death of a partner can lead to a change in partnership. Retirement of a partner. When there is a retirement of a particular partner, this also can lead to change in partnership or lead to a change in partnership account. So apart from these three things, admission of a partner, death of a partner, retirement of a partner, amalgamation of a partnership with another business. When we talk about amalgamation is all about metamorphosis, or is all about changing the business line. Maybe you are moving from sole proprietorship to a partnership, or you are moving from partnership to a limited liability company. So amalgamation of a partnership, with another business can also lead to a changes in partnership. So even another thing that can also lead to changes in partnership that we did not mention here is if there is a changes in the agreement. If there is a changes in the agreement of a partnership, changes can actually occur. There are a lot of things that can cause the changes. Natural disaster can make them change the agreement. Government policy can make partnership to change. Government policy can lead to changes, environmental factor. There are a lot of things, that's why I used to say, I normally tell my students that whenever I can ask a question, don't just limit your answer to what teacher or your lecturer has discussed with you. You can actually think outside the box, think without your note, and come up with, some some question that even when the marker see the question, they will know that what you are talking about, you understand. Like you will not see in any textbook that environmental factor can lead to changes in partnership, but it is a fact. Environmental factor can lead to changes in partnership. Environmental factors such as government policy, it can lead to changes in partnership. these are the things that you can actually bring in. Can bring in your residual knowledge, the knowledge that you have as that relate to your business and business account, or the knowledge that you bring from taxation. You can actually make use of it to answer some question. So don't forget admission of a new partner, death of a partner, retirement of a partner, amalgamation of a partnership can lead to changes in partnership. So the accounting problem are similar in each case, though amalgamation does not have, amalgamation does have an extra dimension, which will be discussed later under the amalgamation. Amalgamation have extra dimension, but when it comes to other, the accounting, they are just similar. Though in each case of the old partnership comes to an end, a new partnership is formed. Whenever there is a cessation to the old partnership, a new partnership will definitely form. Usually the record of the old partnership continue as those of a new partnership, with adjustment to reflect the changes of the ownership. Please note all these things. All these points, they are just very, very crucial. They are very, very important whenever you are preparing a partnership account. And if you have checked, if you are conversant with your past question, your Pathfinder, you will see that partnership account is one of the constant K that you will always see. Partnership account. If you don't see it in theory, definitely you will see at least 5 questions in OBJ that talked about partnership account. So all these small things, you need to pay attention to it, so that by the time we are preparing the account, we'll be able to understand very well. So I highlight here that in each case, the whole partnership comes to an end and a new partnership is formed. Usually the record of the old partnership continue as those of the new partnership, with adjustment to reflect the change of ownership, with adjustment to reflect the change of ownership. Now, Ayodeji and Kendi, they are partner before. They have been a partner for 5 years now. We have our capital, we have current accounts, we have our assets, we have been doing business. Now we decide to admit Temitope as a partner, and Temitope to join us. Now definitely the structure of the account will change, even though we maintain our account before, capital that we maintain, the current account that we maintain, the share of profit that we maintain. So with the admission of a new partner, which is Temitope, definitely the structure will change. That is why I may mention here that the ownership structure, there will be a change in ownership structure. The whole way that we are doing it before, the old thing that we have there before may not change, because the capital that we have, maybe we contribute 1 million naira, it may not actually change, but the ownership structure, or the ownership structure is what is going to change with the admission of Temitope. I hope that is clear. So the main objectives of this adjustment is to establish the capital of each partner in the old partnership. And this is very important. This is actually very, very important. This is very important because whenever there is a change in partnership, you need to reflect that particular change and see the effect on the structure, ownership structure, or the capital structure of each partner. Now, okay, let's talk of what. Let's pick of those things that can lead to changes in partner. Let's pick them one after the other and discuss it. Admission of a new partner. The existing partner, we want the new partner to introduce a share of capital, yes or no. Now, there's no way we want to admit Temitope to join us as a partner that Temitope will not bring up is our capital. I don't know, maybe Temitope is a male or female anyway. Pardon me. So definitely, I assume that she's a female. Definitely, she will bring a capital, to join us, in the business. So if she brings a capital to join us in the business, that means that there is going to be a change in the structure. The size of the amount of capital the new partner must introduce depend on the existing capital of the business. The size of the amount of the capital the new partner must introduce depend on the existing capital of the business. So that's it. On the retirement or a death of a partner, retirement or death of a partner, we treat it alike. When a partner retired or a partner just leave or death of a partner, we actually treat the accounts alike. The retiring partner, we want to withdraw his capital. So this must be measured at the date of retirement. Please note, this must be measured at the date of retirement. Three of us, we are partner. Mr. Kenny decide to retire. That he's no longer interested it's no longer he want to retire. At the particular time, the date that the partner retire, the what's it called? The retiring partner, we want to withdraw his capital. The retiring partner, we want to withdraw his capital. So this must be measured at the date of retirement. A deceased partner's capital must be paid to his estate so that his family or other beneficiary may benefit. So that his family or other beneficiary may benefit. All right. So that is it under the death or amalgamation, death or retirement of a partner. When it comes to the amalgamation, it is important to establish the capital worth of each partner in the new business to show that each partner is bringing to the new business. Amalgamation, as I've explained to us before, that amalgamation, it has to do with, moving, you are moving your business maybe from a sole proprietorship, partnership, from partnership to a limited liability company. That is what is called amalgamation. It's a metamorphosis of a business from one structure or from one business structure to another, from one business structure to another. When we move our partnership business to a limited liability business, it means that is a different business structure entirely. So it is important to establish the capital worth of each partner in the new business to show that each partner is bringing to the new business, to show that particular thing that each partner is bringing to the new business. So this may sound straightforward as capital and current account already exist, I think we have lost the student. Okay, tell back. The internet is bad. Sorry. Anyway, let's continue. We are discussing the amalgamation. We are discussing the amalgamation, as the amalgamation can lead to the. We are discussing the amalgamation as amalgamation can lead to change in partnership. So that's what we are discussing the amalgamation. I was saying that this may sound straightforward as capital and current account already exist. Yes, we have capital and current account. However, the balance on the account is the partner's share of statement of financial position. So the statement of a financial position is a list of asset and liability. You know that, not a statement of value. Is a list of asset and liability. So at the point of amalgamating or at the point of amalgamation, asset of the business will be stated at cost. And this may be very different to their value at the date of change in partnership. Let me explain what I meant. When we have the business, now we have asset and liability that we're carrying in our statement of financial position at the point that we are moving our business to join with another business. Now, the asset that we are carrying in our book, we are carrying it at cost. You know, we are carrying it at cost. And this may definitely be different from the fair value. We call it fair value of that particular asset and liability. So the fair value of those particular asset and liability must be determined at the point that we are moving from one business structure to another. You know, as partner, the three of us, we have assets, we have everything, you know. At the point that we are moving to a limited liability company, you know, the asset must be determined, the fair value of the asset that we are carrying in our book must be determined, because what we are carrying in our book is we are carrying it at cost value. So the asset, I know fully well, I'm aware that you have done IAS 16 and PPE. So we'll have what's it called? Mr. Israel will have taught us on how to measure our fixed asset, how to measure our current asset or not current asset, how to measure our not current asset. So that is where, you know, we'll have taught us how to revalue our not current asset when we revalue our not current assets, or, you know, we'll have also discussed the fair value measurement. So now let's look at this example to buttress what we are talking about as regards to the, you know, the amalgamation. Now I say Ayo and Bola and Caleb were in partnership, sharing profit or loss equally. You know, the firm bought a plot of land in 2001 for 2.5 million. Ayo left the partnership on 30th June 2013. The land was worth 4 million. Knowing fully well that the cost of the land when they bought the land was 2.5. Now, when Ayo left, you know, I told us that under the retirement or retirement of a partner or death of a partner, that at the point that the partner is withdrawing, you need to value the net. You need to do the net value of what, you know, so that you can discover how to share what is actually the worth of the partner that is actually going. Now, Ayo left the partnership on 30th June 2013. The land worth 4 million naira. At that date, you know, the land was 4 million naira at that date. Yeah. Now, the worth of the land at that particular date is what is called fair value. Fair value. That is what I'm talking about. The worth of the land at that particular date is what is called fair value. Now, the land has risen in value by what? 0.5 million. And ordinarily, if the land has risen by value by 1.5 million, because we are told that they share their profit and loss equally. We are told that they share their profit and loss equally. It means that if the land has appreciated in value by 1.5 million, it means that if they have to share this 1.5 million, they have to share it equally, meaning that 500,000 naira will be given to Ayo that is leaving the business at this particular date. You know, that's what I'm trying to talk about. So the land has risen in value to 1.5 million. But this is not reflecting in the financial statement. This means that Ayo's capital does not include his share of the gain, but clearly 500,000 of the gain belongs to him. Yes, clearly 500 of the gain belongs to him because they are sharing their profit or loss equally. They are sharing their profit or loss equally. So that's what I'm trying to talk about there. So I said somehow the extra amount must be accounted for so that Ayo can benefit from this. The extra amount must be accounted for so that Ayo can benefit from this. So that's how the what's it called? Whenever a partner is retiring or whenever a partner is leaving the business, that's how you actually revalue the assets and even the liability that they have, to know the net worth of the partner that is actually living. Note this, please. Note this. The firm's net assets are not the same as the value of the firm, and each partner will be more concerned with the later figure. Do you understand? Please note this one. Is this also very important? The firm's net assets are not the same as the value of the firm, and each partner will be more concerned with this later figure. The partner will be more concerned with the later figure that they have in their business, you know, rather than the book value. The book value may not be, it won't show the true and fair view of what they have. You know, the fair value will actually be more appropriate to use to share their profit or loss. Okay, let's go on. I have another illustration to portray what we are talking about. Ade and Bolu and Kola were in partnership, sharing profit and loss equally also. Ade left the partner on 30th June 2013. At this date, the net asset of the firm was 6 million. The value of the firm was estimated to be this. The net asset was 6 million. The value of the value of the firm was estimated to be 9 million, meaning that the difference of 3 million is called goodwill, and this will be explained shortly. Anyway, this will be the goodwill will be explained shortly. But this 3 million must be shared. You know, Ade's share of the net asset might be 2 million, but this share of the value of but his share of the value of the firm is 3 million. Somehow the extra amount must be accounted for so that Ade, I want to put here, please pardon me, Ade can benefit from this. So this 3 million, the extra 3 million that was revalued, that increased the value of the company, must be accounted for in such a way that Ade will be able to benefit from the goodwill, even though Ade is leaving the business. But when Ade was still part of the business, Ade was part of, when Ade was still part of the business, that is when they acquired the 3 million naira goodwill. So it must also benefit from the sharing or from the benefit that might have been accrued to this business, which is 3 million naira in value. So the solution to the above problem is that the net asset must be revalued so that the partners share in any adjustment. So the difference between the value of the firm and the net asset of the firm, which is goodwill, must be recognized. So I want to believe that you understand that one perfectly. You understand that one perfectly. You know, invariably what we are talking about or what we have been discussing before I go to goodwill, because goodwill is another thing that we need to discuss extensively under this partnership. But before I go to goodwill, what we are talking about is that either the death of a partner, the withdrawing of a partner, the leaving or the retiring of a partner, or amalgamating of a partner, you must revalue, you must check the net value of the asset that they are carrying in the book for you to know the current amount of the value, because you cannot use the book value of the asset, of the book value of their financial position to know the net worth of the returning partner or the partner that is withdrawing from the business. So that is why you must actually carry out some financial activity, some computation for you to know what X to do. So I want to believe that that is actually clear. Please, if that is not clear, if there's anything that you want me to explain further, you can actually drop it in the chat button, so that at the end we are going to check the chat button. If you have any question there, we will be able to tackle it. So let me just do something. Sorry, just a minute. I'm trying to position my. Okay. All right. So let me go straight to goodwill. Goodwill is another thing. I saw, anyway, it's part of the question that we're going to treat today. Is a Pathfinder question where I ask question as related to goodwill in partnership account. So you cannot joke with every point under this partnership, preparation of a partnership account. Please don't joke with it. If you don't see it in your theory question, you will definitely meet it in your OBJ at least 5 questions. 5 questions, at least 5 questions. Okay. So under the goodwill is the amount by which the value of a business exceed the value of all its net assets. That is in kindergarten and definition anyway. When you go to another level, when you go to a skill or professional level, we are going to be talking in a wide way what is goodwill all about. But at this particular level, this is the definition that you are meant to know, and this is the what just to bring it down. Goodwill is the amount by which the value of a business exceed the value of all its net assets. And when you say net asset is asset less liability. All your asset less all your liability is what is called your net asset. Your asset less liability is what is called your net asset. So when the value of your business is more than the net asset, it means that you are showing goodwill in your business. So, with that particular knowledge, if I can't even ask you, if an examiner asks you that what do you understand by goodwill, you should be able to say something about goodwill. Just like the way I've explained now, you should be able to mention and say something about goodwill. So goodwill is an intangible asset anyway. It's an intangible asset. It's not something that you can see. It's not a plant and machinery. It's not a PPE that you can actually see on the way you see other assets. Goodwill is an intangible asset of a business, but normally it is not recognized as an asset in the financial statement. The value of a business is usually more than the net asset of the business because it reflects the trading potential that the business that the business is having. That is its ability to generate profit in the future. So you may not see it in the statement of financial position mention it that PP 20,000 naira goodwill. You may not actually see it, but when it comes to when you are consolidating, when it comes to the next level, which is our skill level or foundation level, we talked extensively as regards to the goodwill. So what am I trying to explain? Sorry, my note escape. Sorry. So what we are talking about is that all successful business or businesses have goodwill, which means that the buyer will be prepared to pay more to acquire the business than the value of its assets. All the successful business has its own goodwill. All the successful business has its own goodwill. It means when we say you have goodwill, it means that the buyer of that particular business will be interested to pay above the net asset of that particular business. The buyer will be interested to pay above the net asset of the business. All right. So this is a simple illustration about goodwill. If we ask to calculate goodwill, value of the firm. This is the value of the firm, and less asset less liability of the firm. And the answer will give you goodwill. The value of the firm, the value that the buyer is willing to pay minus the net asset will give you goodwill. That's it. That's the goodwill. Even in a professional level, in a skill level, that is the goodwill. The value of the firm minus the net asset of the firm will give you goodwill. Okay, so let's go on. And now let's look at this. Let's look at this short illustration. A firm has a net asset of 1 million naira. One of the assets held by the firm is a property at cost less accumulated depreciation of 400,000. This property has a market value of 600,000. Yes, I want to believe that you understand this one. On Monday, we treated something like this. You have a cost less accumulated depreciation. And the carrying amount will be what? Will be 600,000. That's what I call the market value. The carrying amount will be 600,000. Yes. So this property has a market value of 600,000. 200,000 above its book value. The firm is valued at 1.8 million. Now, the firm is valued at 1.8 million. So let's look at this one, goodwill calculation. We look at it in two different ways. Calculation, why without revalue the asset, and goodwill calculation with revaluation of the asset. I hope we understand. Goodwill calculation without the revaluing of the asset, and goodwill calculation with revaluation of the asset. Now let's look at it. Value of the firm. They told us that the value of the firm is 1.8 million. This is the value of the firm is 1.8 million. Now, asset less liability as per the account. Asset less liability as per the account. Without revaluing the asset is 1 million. When you less liability, asset less liability is 1 million. So asset less liability at fair value. We have been told that asset less liability as fair value. Asset at fair value is what? Is 1.2. This is it. They said a firm has net asset 1 million, but at fair value is 200 above its book value. That means it has 1.2. 200 above its book value. Book value is 1 million, and 200 above its book value. So let's look at it. When you don't revalue the asset, you have a goodwill of what? Of 800,000. But immediately you revalue the asset, you have a goodwill of what? Of 600,000. I hope it's very clear, because you minus the liability is 1.2. When you minus the liability from the value of the asset, you get 600,000. When you minus the liability here from the value of the asset, you get 800,000. So that's how we get the goodwill. So it's always important of the asset that you are carrying in your book. You need to check the fair value of the asset that you are carrying in your book. So at this junction, now, if you now want to share the amount shared by the partner, you see the goodwill here, 800,000, goodwill 600,000, revaluation gain that they have, 200,000, and amount shared by each partner will be 800,000 and 800,000. So it's just so straightforward. We understand this one better by the time we are treating questions that relate to the goodwill. We have a comprehensive question that relate to the goodwill. So by then you will understand this one better and clearly. Now, let's look at the accounting for change in partnership. So how do we account whenever there is a change in partnership? How do we account for it? So please pay attention here. please pay attention here. We are going to be doing some calculation. I mean, we are going to be doing mentioning some step here that will help you whenever you are preparing a partnership account. So accounting for a change in partnership. Now, the old partnership comes to an end and a new partnership begins, but the record of the old partnership continue as those of a new partnership with adjustment to reflect the changes in partnership. I've said that before. This one, as previously stated, this one is a quote that I've said before. I just deliberately repeat it here so that it sync, So the adjustment aim to establish each partnership share of the worth of the firm in the old partnership. This is done by recognizing goodwill and any revaluation gain. Whenever there is any revaluation gain, it is actually done by recognizing goodwill, and whenever there is any, whenever there is any revaluation gain, we also account for it accordingly. All right. Now let's look at it. Let's look at this journal to recognize goodwill of the old partner. Journal to recognize goodwill of the old partner. What do? You debit the goodwill and you credit partnership capital in the whole partnership profit sharing. If they have a certain percentage that they are using to share their profit, you are going to credit that partnership capital account. I told us that partnership capital account is a credit balance account. Because of what? Because it's an equity account. It's like a liability account. Just like an asset account is a debit balance account. Asset, either non-current asset or current asset account, they are debit balance account. So you debit the goodwill, which is look like an asset account, and you do what? You credit a partner's capital in the old partnership profit sharing ratio. In the old partnership, you put that being recognizing or recognition of a goodwill prior to change in partnership. You need to recognize the goodwill prior to change in partnership so that you are not shortchanging the old partners. So you need to pass this particular entry in order for you to have a good, in order for you to expect your account to balance. So after that, the partnership figure is not usually retained in the account. The goodwill figure is not usually retained in the account after the changes in the partnership. It is removed as follow. The goodwill will also be removed, because why the goodwill will be removed is that you are changes from the old partnership to a new partnership, so you cannot be carrying it along because you have actually accounted for it. So the goodwill will actually be removed, but you also need to pass a certain journal before you can actually remove the goodwill in the old partnership account. Now, this is how to remove it. Journal to remove goodwill from a books of the new partners. Journal to remove goodwill from the book of a new partner. What do? You debit partners capital in the new partnership profit sharing, and credit goodwill. You have debited goodwill up here. You have debited goodwill up here, and you credit here. So if you do, you pass this entry, definitely this goodwill will be removed. You have credited partners capital account here, and you did what here? You debit it here. If you pass this entry, definitely this particular if you pass this entry, definitely what? The goodwill will be removed from the book. The goodwill will be removed from the book. All right. So that's how to account for the goodwill in the both old and new partners account. That's how to account for the goodwill in both old and new partners account. So now, I want us to go to this particular step, because this also will help you by the time you are accounting for and you are admitting a new partner and you want to account for it for the good way. This particular step will help you. So admitting a new partner is the next thing that I want to discuss now. Admitting a new partner. When a new partner is admitted to a partnership, the following steps are required. The following steps are required when a new partner is coming up. The following steps are required. Number one, measure the good way. That's the first step. You need to check the good way. Is there any good way in the whole partner? So you need to measure the good way. Measure the good way of the old partner. This figure we usually be giving anyway. In the question that I've treated in the past, this question is usually be ICANN will always give you this particular this figure. You measure the good way of the old partnership. After measuring the goodwill of the old partnership, you did what? You recognize goodwill sharing. Recognize goodwill sharing the credit entry to the partners of the old partnership in the old profit sharing ratio. If you this particular point that I mentioned here is the first journal that I show us here. This journal, this journal, this journal, this journal. Debit the goodwill and credit and partners capital account. That is step number 2. That is this step number 2. Partnership goodwill sharing. Recognize goodwill sharing, the credit entry to the partners of the old partnership in the old profit sharing ratio. That's step number 2. Step number 3, you need to remove the goodwill in the book of a new partners, sharing the debit, posting the debit entry to the partners of a new partnership in the new profit sharing ratio. So when you post this one, definitely the goodwill will be removed automatically. The goodwill will be removed automatically. And the last step, which is step 4, account for capital introduced by the new partner. So 4 things. Number 2, you need to measure the goodwill. Number 2, you need to pass the first journal entry by doing what? By debit the goodwill and credit the capital account of old partner. Number 3, you need to remove the goodwill. And number 4, you need to account for the capital introduced by the new partner. Please, this step, they are just so important. I have also seen in your question before, in your past question before, why they ask us to itemize the step that you will take in accounting for admitting a new partner. These are the 4 steps that ICANN is expecting you to mention. These are the 4 steps. Please, let's try and just see it as something that is just so easy. Number 1 is for you to measure the goodwill whenever you are admitting a new partner. Number 2, you need to account for that particular goodwill by debiting the goodwill and credit the partner's capital account with the old sharing ratio. Number 3 is to remove the goodwill from the account, by passing a necessary journal. And number 4 is to account for the capital introduced by the new partner. It's just so straightforward. If they ask you to mention this one and they mention certain mark, either maybe 2, 3, or 4 marks, it should be a bonus mark for you. Thank you. Let's go to retirement or death of a partner. What are the steps that we need to take by the time we are accounting for retirement or a death of a partner? What are the accounts that we are supposed to take? So we have 4 steps as well. They are almost the same thing. measure goodwill of the old partner, recognizing goodwill, remove the goodwill, and account for the capital taking. Account for the capital taking. So this is a way of, accounting for the admitting or retiring of a partner, admitting or retiring of a partner. This is the way of accounting for it. All right, because the time is not, our time is fast spent. Let's go to amalgamation and dissolution of a partnership. Amalgamation and dissolution of a partnership. I have told us the meaning of amalgamation, and I also believe that we understand the meaning of dissolution. Please give me just 1 minute, please. 1 minute, please. All right, let's continue. Amalgamation and dissolution of a partnership. What do you understand by the word amalgamation? I've explained it to us in a layman language before, but by definition, an amalgamation is where two or more partnerships combine to form a new partnership. An amalgamation is when two or more partnerships combine to form a new partnership, or where a sole trader and a partnership combine together. That is what is called amalgamation. And that is what is called amalgamation. So there is strong similarity to the changes already covered with a revaluation made in the old book and the reversal made in the new book. You may have to construct a statement of financial position immediately after the amalgamation. You may have to compute or construct or prepare a statement of a financial position, either compute, construct, or prepare a statement of a financial position after the amalgamation. The added dimension to this sort of question is that this involves merging the statement of financial position of two businesses that are amalgamating. We have a question that we have a question here that actually we use to treat this amalgamation question. We have an icon question here that we are going to discuss together. So you may have to prepare a separate financial statement, a financial position to bring together the financial, the interest of each partners. Whenever you are accounting for amalgamation of a partnership, whenever you are accounting for amalgamation of a partnership, So I have a simple example here. Anyway, A and B are partners sharing profit or loss. I have a simple example here that talk about amalgamation. A and B are partner sharing profit or loss equally. C and D are partner in another firm. They are sharing profit equally also. They are sharing profit equally. The two firms are to amalgamate with A, B, C, and D, sharing profit or loss in the ratio of 3 to 3 to 3 to 2 and to 2. The statement of financial position of each business immediately prior to the amalgamation and above any of the necessary amalgamation adjustment was as follows. Okay. They have their statement of financial position, A, B and Co, and C, D and Co. This is the statement of prior to the amalgamation. The non-current asset of what's it called? A, B and Co is 200,000. C, D and Co is 175,000. Current asset is 100,000 and C, D and Co is 80,000. So they all have They all have what's it called? Their value is 300,000, and then CD has 255,000. Now, let's go on. The capital of A and B is 120,000 respectively. C and D have 100,000 respectively. And C, the what's it called? CD and Co has a liability of 55. So what I'm trying to establish here is that now, when they have the capital is this, the liability is what? Is 60,000 and 55,000, and their net, the what's it called? The net liability is 300,000. So this is how the amalgamation is being prepared. Even though this one is actually very short, but the comprehensive question that I have is still under our notes. We are going to treat our comprehensive question. So don't let us just wait. Waste much time here because of our time that is fast spent. So that by the time we treat the comprehensive question, you understand this one better. Now, apart from that, let's talk about the dissolution. Apart from amalgamation, let's talk about the dissolution of a partnership. The dissolution of a partnership. So a partnership might cease trading. Yes, it's very possible. It's actually very possible. Partnership might cease trading. So when this happens, the partners are set to dissolve their partnership and liquidate the firm. Whenever there is a dissolution of a partnership, the partners, whenever there is a cessation of a partnership, the partners will need to dissolve their partnership and liquidate the firm. When you are doing this, there are some things that you need to bear in mind. When we are doing this, there are a lot of things that we need to actually bear in mind when you are dissolving a partnership and you are liquidating a partnership. It's not just something that's actually very straightforward like that. We have itemized here some steps that we need to take note, some steps that we need to actually follow whenever there is a dissolution of a partnership. Let's take those steps one after the other. And we also need to consider the account that we might need to prepare whenever there is a dissolution of a partnership. Now, number one, some assets of the firm are sold at a profit or loss, which must be shared between the partners in their profit sharing ratio. This is straightforward. We are dissolving our partnership. Ayodeji, Temitope, and Kendi, we are dissolving our partnership, and we are selling the asset that we have in the book. Because we have a sharing ratio that we are using to share the profit and loss. So the first thing that is going to happen when we are dissolving this partnership is that the asset that we have, either the profit that we make or the loss that we make, needs to be shared according to our profit sharing ratio, profit or loss sharing ratio that we have in the agreement. That's number one thing that we need to do. Number two, other assets might be taken by the partners in partners settlement of their capital. Other assets might be taken by the partners in the partner settlement of their capital. This is also very possible when we are dissolving a partner. We can decide that a partner, hey, Temitope wants to take motor vehicle, why Kende wants to take generator, and when Ayodeji wants to take the furniture. All these things can actually happen whenever partnership is dissolving their partnership agreement or partnership business, and all these things must be accounted for, because before a partner can lay his hand on a partnership asset
or on the business asset, the value of that particular asset must be realized. The value of that particular asset, the fair value of that particular asset must be noted. It must be known, because that particular thing will be accounted for in the partner's current account. The liability are paid through the liability are paid, though some might be accepted by the partners, and this will also increase its capital balance. If some liability is accepted by a partner, it will increase the capital balance of each partner. And finally, the balance on the capital owed to the partners is paid off using the remaining asset of the business. Alternatively, a partner might have to pay cash into the business if there is a debit balance on his capital account. If there is a debit balance on the partner's capital account, it means that the partners are showing more than what is actually owing, or what is his stake in that particular business. The partners are taking more than what is actually having in that particular business. It means that the partner will be paying back to the business. The partners will be paying back to the business. That is why you need to understand the double entry principle very well. It is the key for you to be a successful accountant. Is the key for anyone to be a successful accountant. For example, when I say that if a partner might have to pay pay cash into the business if there is a debit balance. If capital account of a partner has a debit balance, it means that the partner is owing. The partner is owing. That is why the partner is having a debit balance in his capital account, because ordinarily capital account is a credit balance account. So if the partner is now having a debit balance in the capital account, it's showing that the partners are taking more than his stake in the business, and he needs to pay back at the point of dissolving the partnership account. He needs to pay back at the point of dissolving the partnership account. So how do we account for the asset? If we have to sell an asset, which will take us to a realization account. This will take us to realization account. So, as realization account is used to calculate the profit or loss on disposal of an asset. That is actually the usefulness or the use of a realization account. Why do we prepare the realization account in partnership account? Discuss. That's the question. 5 mark. A realization account is used of assets. Whenever there is a disposal of an asset, a realization account is actually used to calculate the profit or loss that might arise on disposal of the asset of the business. So all assets has to be sold anyway, and those taken over by the partner at agreed value are transferred into the account at their carrying amount as debit balance. They are transferred into the realization account as debit balance. Note that for a non-current asset, this will be cost less accumulated depreciation. You cannot transfer non-current asset at cost to the realization account. It is not done because of what? Because depreciation, the asset has an accumulated depreciation. The wear and tear of the asset has taken place. The asset has generated a lot of revenue. So you are only taking the carrying amount of the asset. That is for the non-current asset anyway. The carrying amount of the asset is what you are going to taken to revaluation realization account. Don't make a mistake and go and take the cost of the asset. It is not done. Okay. So whenever there is any profit or loss on the realization account, is actually share and taken straight to capital account. Please note, realization account, is housing. The realization account, what it's meant for is those assets that you dispose. And you put those assets that you dispose on the debit side of the realization account, the value of the asset. If our asset is, we have a motor vehicle in our partnership account, we have a motor vehicle that is cost 1 million naira. And at the point of disposal, we dispose it for 300,000 naira. It is the disposal amount. It is that particular amount, 300,000 naira, that you are going to take to the realization account for you to know the profit or loss that you are going to realize on the dissolution of the partnership, because the profit or loss that you are going to realize will be shared according to what? According to the profit sharing ratio that the partners have agreed on at the start up of their partnership account, or at the partnership agreement, agreement and partnership deed or partnership agreement. So this is just the format of a realization account. It's just so straightforward. All this debit is a carrying amount of the asset that you have in your book, and the proceed, when you sell the asset, these are the proceed, what you realize there. And when you minus what you realize from the asset, you are going to get a certain amount that is going to be shared according to the sharing ratio that we are using to share, according to the sharing ratio that we are using to share the profit or loss of the partner. To share the profit or loss of the partner. So that's how the realization account is being prepared. So we have actually come to the end of a partnership account. So, but now want to consider the examinable illustration. Want to consider examinable question. Examinable illustration is actually one of the past question, one of the ICANN past question. I have two questions that we are going to consider before we call it a day, and we call it a topic, so that if you have any question to ask, please drop your question in the chat button. I'm going to treat it after the class. If you have any question, just drop your question there. I'm going to treat it after the class. So let's look at this illustration. Let's look at this illustration. Yerima and Boluke have been friends for some time, and they both had different businesses as sole trader, and decided to form a partnership with effect from May 1st, 2017. This is what is called amalgamation. This is an illustration that is actually going to deal with amalgamation. That is going to deal with amalgamation. So Yerima and Bukola or Boluke have been friends for some time, and they sole trader and decide to form a partnership with effect from May 4, 2017. With effect from May 1st, 2017. Their respective financial position on April 30th, 2017 are as follows. Their respective financial position on April 30th, 2017 are as follows. Now, we can see here, this is their liability in a capital account, and this is the asset, this is the column of the asset account. Okay. Yerima you can see Yerima has a capital of 50,000, Boluke has a capital of 80,300. They have a payable. They have a payable of what? They have a payable of this amount and this amount, and they have a loan from a business associate. Boluke has a loan from a business associate of what? Of 20,000. That's a 20 million. They are all in thousand anyway. Boluke has a loan from a business associate of 20,000. Okay. On their asset side, both current and not current asset. Now, they have a premises, they have an office equipment, they have an inventory, they have a receivable, they have what's called bank, and they have capital, cash. They have cash. And they all have a balance sheet or statement of financial position that is balanced at the end of April 30th, 2017. Don't forget that they are forming a business as at 1st of May. That is when they are coming together to form a partner. So this is their balance sheet and at the end of April 30th, 2017. Now, they have additional information given to us. For the purpose of the partnership formation, the following agreements were reached. They have an agreement that is affecting the partnership formation. For the Yerima, premises were revalued. They revalue the premises. Yerima is having 40,000 anyway. They revalue the premises to revalue. Premises were revalued at what's it called? 30 million naira. They have the premises. Yerima has the premises before for 20 million. So they have to revalue the premises to 30 million, meaning that there is a revaluation of what? Of 10 million naira. And was to be used as an office complex. And the equipment value at 3 million naira was counted as obsolete. Out of this 10 million equipment that Yerima is having, 3 million out of it was revalued. 3 million out of this 10 million was actually counted as obsolete, as a old equipment. 3 million was counted as obsolete as an old equipment. Okay. We are also being told that some of the customers were found unable to pay their outstanding debt. Therefore, 2 million should be written off. There is a bad debt written off of 2 million. 2 million should be written off under Yerima. Under the receivable that Yerima is having of 10 million, 2 million out of it will be bad. At the end, at this particular time, 2 million is bad and it should be treated as a bad debt. So provision has to be made for that particular 2 million. Provision has to be made for that particular 2 million. Okay? So apart from that, Boluke, under Boluke, they also he agreed to acquire out of his private resources additional equipment costing 3 million. Out of his private resources, they agreed to acquire additional equipment costing 3 million. They also agreed to pay his payable from his bank balance. They agreed to pay his payable from his bank balance to the tune of what? Repay his loan by himself and bringing in his other asset at the book value. So these are the agreements. Please just try and study this agreement and understand within 2 minutes, please. Study this particular question and understand within 2 minutes. I've explained the question to us and we are going to see how we have actually treated it. Within 2 minutes, just study the question. Study the question within 2 minutes and understand they have their fixed asset, they have their liability, they have their capital, they have their liability side, and they have their asset side. Both of them, they are coming together, you know, they're coming together. Okay. So please study it. I'm not going to go through the question again. So you see, this short question or this simple question, prepare the statement of financial position of a partnership of Yerima and Boluke as at May 1st, 2017. Prepare. What do you need to use just to bring their fixed asset together? Just bring their fixed asset together. Make sure you consider the value of the asset is obsolete, the debt that they are not unable to pay. You need to consider all those things and bring the asset together. By the time you are bringing the asset together, you will see that, you know, if at all, if you don't even know this one before, you know, you should be able to bring this asset together because we have a balance sheet, one balance sheet that has been prepared for us before. Now they want us to bring it together, you know, using the information provided and making references to the agreement of the Yerima and Boluke. So if you are able to bring this one together, you should be scoring at least an average mark of like 8, 7, 6. You know, if you are scoring a mark like that, you are doing fine. You are doing fine. At the end of the day, you will see that you will definitely pass the course. So prepare the statement of a financial position for the partnership of Yerima and Boluke on May 1st, 2017. That's A. B. State 10 provisions that should be contained in partnership agreement. 10 provisions. We've treated this type of question last week, but if you don't remember those provisions, don't mind, I can accent 10 provisions. They are talking about agreement, partnership agreement. What are those things that you need to put in the partnership agreement? 10. It means that if it is 5, you are able to remember, it's 5 marks that you are going to score. If you are able to remember 7, it's 7 marks that you are able to score. See, question like this, you should be able to remember the 10 so that you can score your 10 marks. You know, this is an icon question anyway. I think 2018, May 2018 or 2017 question, you know, is an icon question. Let's look at how they have prepared the statement of financial position as at May. This is how they have prepared the Yerima and Boluke statement of financial position as at May. You know, this is how they have prepared it. And this particular account also has it has some notes to the account. We have revaluation, we have bank balance, and we have the capital account. Because those accounts, you cannot just lift this particular, the figure that relate to capital account, the bank balance or cash balance, and the revaluation, you cannot just lift it from the question. You need to prepare notes to the account before you can actually know how they affect the partnership balance sheet account or statement of financial position account. But meanwhile, the figure that you are going to be using here is going to be the figure that the additional information has affected. For example, let me take, for example, premises. Now, look at the premises. Look at what they gave us here as premises. Look at the premises here. They said 70,000. How do we get premises to be 70,000? You know, knowing fully well that in the question, we are being told that the premises is 60,000, 20 plus 40 is 60,000. Yerima is having 20, Boluke is having 40, and you add the both figure and the figure together, you get 60,000. But when you pay attention to the additional information given to us, it said premises were revalued at 30 million, which is 30,000, 30 million. Now, if premises were revalued at 30 million, it means that it was 20 million before. Yerima premises was 20 million before. They revalued at 30 million. It means that the premises now has an additional value of 10 million. That is how they are be able to get the 40. That's why they are be able to get this 70 million. This 70 million. So the what's it called? 20 million for Boluke and 40 million for 20 million for Yerima, 40 million for Boluke, and 10 million revaluation will give us this 70 million. I hope that is clear. Look at the premises. I mean, look at the office equipment, 30 million. If you look at the office equipment also, it's the same thing. If you look at the office equipment, what are the information that affect the office equipment? We are being told that he agreed, Boluke agreed to acquire out of private resources an additional equipment costing 3 million. Additional equipment costing 3 million. Now you see additional information under Yerima also. They said the equipment value as 3 million was counted as obsolete. Equipment value as 3 million was counted as obsolete. And they are having office equipment here as what? As 30 million. They have office equipment here as 30 million. Now, see what I'm talking about. They are having office equipment there as what? Let me see. As 30 million, office equipment as 30 million. Now, if they have office equipment as 30 million here, it is not this same 30 million that they bring down here. It is just coincidence that it is 30 million. It is not that same 30 million, because what they have brought down here is that 30 million minus the 3 million naira obsolete, the equipment that was obsolete, and plus the 3 million naira, this 3 million naira actually nil of this 3 million. 30 million plus the 3 million naira minus the 3 million naira will give us what? 30 million. That is how they are able to get this 30 million. I hope that is clear. I hope it's actually clear. It's actually straightforward. So that is what you need to do as regards to other assets. That's what you need to do as regards to other assets. But let me just go straight to the additional information that is relating to revaluation. The additional information that is relating to revaluation. On the revaluation, we have been told that the premises is going to be valued from 20 million to 30 million, meaning that there's going to be a revaluation of 10 million. You see, there's a revaluation of 10 million for the premises. And we have been told that the office equipment that Yerima, Yerima is bringing is obsolete. One of the office equipment that Yerima is bringing, part of it, 3 million naira, there is obsolete. That is why the Yerima revaluation account is being credited with 3 million naira, so that the balance of the equipment will be reduced by that particular 3 million naira. And we're also being told that it needs to settle its receivable, which is there is going to be a bad debt of 2 million naira. So by the time the 3 million naira obsolete and the 2 million naira receivable bad debt is removed from the 10 million naira of the revaluation that he has there, his capital will be reduced to what? To 5 million. His capital will be reduced to 5 million. That's how to get the capital for Yerima for 5 million. That's how to get capital for Yerima for 5 million. Now, let's look at the additional. Let's look at the note for the bank balance transfer to the partner. The bank balance transfer to the partner. In the bank balance, we have a balance brought forward. We have a balance brought forward of 5 million and 10 million. How do we get the balance brought forward from 5 million and 10 million? How do we get the balance brought forward of 5 million and 10 million? Now, this is it. Bank balance. We have a bank balance where we have a balance brought forward of 5 million for Yerima and 10 million for what? For who? For Boluke. So that's their balance brought forward. So apart from that, what are other things that affect their bank balance? What are other things that affect their bank balance? You know, they need to settle payment to supplier. Both of them, they settle. Yerima settled with 500,000, while Boluka settled with 1.2 million naira. And after that, their bank balance will be adjusted, and they are going to be getting the bank balance of Yerima will be having 4.5 million, while Boluka will be having 8.8 million. By the time you add the both together, that is what you are going to post to the statement of financial position of both partners as at 1st of May. That is what is going to post to statement of financial position of both partners as at 1st of May. So we can actually check that out. If we check the bank balance in the statement of financial position, you know, 4,500 plus 8,800. 4 plus 8, that's 12. 8 plus that's 13. That would be 13,300. So let's see what was recorded in their bank balance. This is it, 13,300. That is what was recorded. It is the balance that they have as at 1st of May. That is the balance that they have as at 1st of May. So capital account also the same way, you just treat it the same way. You know, I don't want to waste much time. We still have another question to treat. So that's how to actually prepare their financial position account. And at the end of the day, their financial position will definitely balance. Their financial position will definitely balance. So that big question, please just read it on your own. 10 things that you can include it in their partnership agreement. I have more than 10 here anyway. I have like 14 things here that must be included in the partnership agreement. I have like 14 things here that must be included in the partnership agreement, you know. So you can actually go through this one on your own. Capital must be there, profit sharing must be there, interest on capital or drawing must be stated, interest on loan must be stated, whether current account has to bear interest. All these things must be stated in their agreement. That is why I said, you know, the partners agreement, you just need to think outside the box. When you are able to think outside the box as regards to the partnership agreement, you will come up with even a point that is actually more than the requirement. You know, as here and they ask us to list 10 agreements, 10 points that can be included in the partnership agreement, and I listed 14 here. You know, I listed 14 here. Capital needs to be included. Profit sharing ratio needs to be included. Interest on capital or interest on drawing. Interest on their current account, you know, they need to agree on that. Interest on the loan by the partner, they need to agree on that. They need to agree on whether partners, you know, whether partner and the drawing are to be limited in amount. You know, the amount, they need to agree on that. Whether partners are entitled to remuneration for their service before arriving at the division of profit. You know, I told us when we were talking about notional salary, I told us, you know, these are some of the things that needs to be agreed in the partnership agreement. The method and procedure for settle disputes, because there might actually be a dispute, whether they will have a committee or whether the method, this can actually be stated in the partnership agreement. the method of determining the amount due to decease, if there is any retiring of a partner, the method that needs to be adopted in the rate of interest or allowing or outstanding balance that the partners is having, can also be part of what you need to state in the partnership agreement. The need to audit the partnership account and how the auditor has to be appointed, needs, you can also be part of what you need. You can also be part of what you need to state in the partnership account. The partnership agreement can also be part of what you need to state in the partnership agreement. So they are just the list is endless. It depends on the angle that you are looking at it. It depends on the name of the firm can also be part. The type of the business of the firm can also be part. The type of the business, the expiration of the partner can also be you can just think of different things. Just think of different things that you can form the partnership agreement. So when you read this one, if you have any other question, just let me know. If you have any question, just let me know when you go through all this. All right. Let's look at the illustration 2. Because illustration 2 is talking about goodwill of partner. Illustration 2 is actually talking about goodwill of partner. Illustration 2 talking about goodwill of partner. So looking at the illustration 2 is also an ICANN question. I think in 2017. I think this one is an ICANN question 2017. Question number 5 or question number 4 is also 20 marker question. So let's look at this, the question. A number of factors will lead to the creation of a goodwill in partnership. A number of factors will lead to the creation of goodwill in partnership. Require divine goodwill and explain its recognition in partnership account. 3 marks. Divine goodwill and explain its recognition in partnership account. 3 marks. So I've told us the literal meaning of a goodwill. Goodwill is just the value of the firm above the net asset of the firm is what is called goodwill. So if you are able to understand what goodwill is all about, you'll be able to earn your good mark as regards to this particular question. Number 2, state three example of circumstances in which goodwill may be created in partnership. 3 examples of circumstances in which goodwill may be created in partnership. So number B question. Adeolu and Kola are in partnership sharing profit in ratio 3:2:1 respectively. On March 31st, 2016, their statement of financial position shown below. Look at their statement of financial position, capital, current account, and liability account. So their statement of financial position shown below. We have additional information. On April 1st, 2016, Ade retired, and the following terms were agreed according to their partnership deed. You can see what I'm talking about here. Retirement of a partnership. See what I'm talking about now. Retirement of a partnership. Retirement of a partnership. So goodwill was valued at 1,572,000. 1,572,000. That was the value of the goodwill, and was not to be retained in the book of the continuing partners, Olu and Kola. After Ade retired, the goodwill was not to be taken, meaning that they need to account for the goodwill and need to write off the goodwill. So Olu and Kola agreed to continue sharing the profit in ratio 2:1, ratio 2:1 respectively, and to maintain their current account. Ade should take a car with carrying amount of 456,000 at a valuation of 322,000. Valuation, carrying amount, valuation, carrying amount. So you must know the figure that you are going to use by the time you are preparing your revaluation, by the time you are preparing your revaluation account, or you are preparing account revaluation account, revaluation as regards to the Ade account, because Ade is leaving that particular business. Now, Ade should receive a cash of 405,000 and retain the balance in a loan account bearing interest at 12%, meaning that Ade want to retain his balance. By the time Ade is being paid 405,000, he want to retain the balance, as a loan to the partnership now. As a loan to the partnership. Ade is retiring, Ade is leaving, but he want to retain his own profit sharing as a loan to the partners, as a loan to the partners at the interest bearing ratio of 12%. Okay, required. Prepare a capital account, cash account, and loan account in the book of the old partner, 6 marks. Capital account, cash account, and loan account in the book of the old partner. Number 2, prepare the statement of financial position of the new partner, of the new partnership as at the April 1st, 2016, after giving effect to the retirement of Ade 8 marks, So all the small account that we have been preparing before this is what we are going to match together now to see how we can actually prepare this account, I've taught us how to prepare a capital account. I've taught us how to prepare a cash account. We have discussed how to prepare a current account. And the loan account also, we have also discussed it. And if you have not discussed the loan account, I'm sure Mr. Israel has actually taught us on how to prepare, to open an account in different ledger. Yesterday, we opened account. We also open a loan is a liability account. It's part of a liability account. So if you can open a liability account, you should be able to open a loan account. All right. So let's look at the way we have drafted the solution. Don't let me waste time on definition of goodwill. We have I've given the definition of goodwill here. You can also go through it because we have just a limited time. And also number 2, that they ask for goodwill is normally created when there are changes in the partnership, such as during the when they ask. Okay, they ask for, what do they ask for? They ask for state 3 example of circumstances in which goodwill may be created. You see, 3 example. When we are admitting a new partner, when a death of a partner, or retirement of a partner, or amalgamation of a partner, these are what they are talking about here. 3 marks. We should just state, retirement of a partner, a death of a partner, admitting of a partner, amalgamation of a partnership. So that's what they are talking about there. You will earn your 3 marks free of charge. You earn your 3 marks. You see, goodwill is normally created when there is changes in the partnership, such as admission, retirement, amalgamation. Admission, retirement, amalgamation, or death. That's how to tackle that one. You score your 6 mark. So let's look at how to now prepare. They said we should prepare a capital account, cash account, and loan account. And meanwhile, whenever a partner is going, you need to prepare a realization, so that, I told us that you need to prepare a realization so that you will know the net value, net asset of that particular, of that of that particular client or partner that is actually going, you'll be able to know that, oh, how much is this partner actually worth, and you'll be able to post it to the capital account of that particular partner. Now, look at the asset, look at the realization account that we prepare. Now, the motor vehicle is going to be realized as 456,000. You know, Ade capital account car is 320. Loss on realization, these are loss on realization because the motor is only motor vehicle that they are giving out to Ade, and the book value of the motor vehicle is 456, and they want to give it to Ade at rate of 324, meaning that there is going to be a loss on evaluation, on realization. So that loss must be shared according to the sharing ratio. They have given us a sharing ratio that they are using. So that loss, if you minus 324 minus 456, you share the loss according to their sharing ratio. And if you share according to their sharing ratio, Ade will be partaking of 66,000. So 66,000 that Ade will be taking, the loss that Ade will be taking, will be posted to the capital account of the Ade account. It will reduce what is actually due to Ade. If you go to the capital account, these are the capital accounts, you will see that they have a balance. Capital account is a credit balance account anyway. They have a balance. This is the balance that they have at the beginning of that particular dissolution or retiring of Ade. Now, they have this one. Ade loss of a realization is 66. Olu will get this, Kola will get this one. And goodwill written off, these are goodwill that they are going to write off. And the cash account will be this. So the loan that Ade will get now, the loan that Ade will get is going to be a balancing figure. By the time you add all this one together, you minus this one, you get 2,510,000. That will be a balancing figure that Ade said he wants to put in the account with the interest-bearing loan of 12%. If you go and see our loan account, you will see that the loan account has, balance brought forward. This is a capital account of Ade 795, and balance brought forward 795. Balance carried down 795. That's 12% of this particular amount. 12% of this one will give us that particular amount. And their cash account also follow the same way. Their cash account also follow the same way. So this is how to prepare. We have treated a question that talked about admitting of a partner. We have treated another question that talked about amalgamation. We have treated another question that talked about a returning of a partner now. So at this junction, you can actually go to your Pathfinder and lay your hand on any partnership that you see there. Go to your Pathfinder, lay your hand on any partnership that you see there. There is no way that you won't be able to tackle any partnership that you see there. So if you have any question, let me know. Even after the class, if you are solving any partnership account, you can actually ask us questions in your chat button, the WhatsApp. Ask us questions, just mention the year that you are considering. Any question that you don't understand, ask us. And then by the time you ask us, we'll share more light on it. So at this junction, we are going to be calling it a day. But before that, I need to check. Maybe if there is any question in the chat button. But as it is now, I cannot see any question in the chat button. So I want to believe that we understand this partnership account very well. Please, before we treat other topic, try as much as possible to go through this partnership account again. Try as much as possible to go through it, especially those again. And any question that you have, let me know. Thank you for the class and thank you for your patience. And this is 11 o'clock, even though we start like 10 minutes behind the time. I don't want to exceed 11 o'clock because that is the agreement that we have with you. So thank you and God bless you. Have a good time or a good night's rest. Thank you. That's the end of the class. And thanks to my host. I appreciate your time.
You're welcome, sir.
Thank you.
Good night, sir.
Yes. Yeah, good night.